I'm joined today by Edwin Wilches, co-head of Securitised Products at PGIM Fixed Income. Edwin is among the incredible investors sharing insights at the Private Credit Investment Forum today. Welcome, Edwin. It's great to have you with us.
It's amazing to be here, Zelda. Thank you so much.
Let's dive straight in. Could you explain the major drivers behind the growing interest in private credit as an asset class?
Yeah, private credit as an asset class has emerged as a necessary, investment option for many investors. It provides additional spread. In particular, ABF or asset-based finance is also provides diversification for investor portfolios. And importantly, within the private space, one key benefit that investors get is really being able to negotiate stronger bond covenants. So as a lender, we're always looking to find ways of protecting from surprises or downside scenarios. And whether it's in the broader corporate credit space or specifically in asset-based finance, we find the ability to bilaterally negotiate debt terms is quite favorable, on top of additional yield and diversification benefits.
And how does asset-based finance distinguish itself within the broader private credit landscape?
The main distinguishing factor and what makes us excited about asset-based finance is really that today most fixed income investors in particular, most of their portfolios are to be dominated by either sovereign risk or credit risk, corporate credit risk, excuse me. What distinguishes ABF is that it's all the non-corporate exposures in the economy. So, ABF is financing the real economy. So I would think of, its contractual cash flows. It's going to be things like, in the consumer space, it's going to be loans and leases. It could be loans and leases used for home improvement or, solar panels. Or other sorts of financings. It's also used for digitizing the economy, driving digital infrastructure needs. So things like data centers, cell tower financings, even things like fiber, and even energy transition. As I mentioned, solar panels, but also we've seen some deals that involving thermal and wind. So I'd say, first principles on ABF, it's really non-corporate. We don't have any exposure to any one company, but rather a pool of loans and contractual cash flows from either consumers or other sources of debt.
And some concerns raised by investors in private ABF and public ABS is the lack of visibility of the underlying credit risk. How do you assess those risks and avoid getting unintended exposures?
Yeah, I think the beauty of ABS and private ABF, candidly, is that we do have great visibility into the underlying portfolios. So generally, when we have a portfolio and it's backed by thousands or maybe it could be even millions of loans, we have access to all these individual line items. We have been active as an investor for over 3 decades in the space. So we do have a lot of experience and data to help us, assess these risks and think about how the changing world and the changing economy could affect these cash flows. But I would say our ability to underwrite all of these deals, whether it's public or private ABF, and we're part of a much larger team. The private ABF effort is an extension of the public business. So we get a lot of synergies just from the research and the longstanding, expertise there. But I would say that, we have an incredible amount of ability to underwrite these deals. And, while there might be some newer asset classes where history is tougher to come by, I would say that's where discipline steps in. And, investors have to, pick the spots that they want to participate in. But, from our perspective, everything that we're participating in is grounded in quite a bit of data and analysis that we can get from years and years of being involved in these spaces.
And what trends or opportunities do you see evolving within the asset-based financing space for investors?
Yeah, look, I think trends, we continue to see, the need for ABF in the real economy really has emerged from banks, both large banks and particularly regional banks, pulling back from lending writ large, or maybe stated differently, as the need for credit formation continues to increase as GDP increases. Banks are a smaller part of that growth, and private markets are growing alongside it. What I do expect to see is quite a bit of growth also in Europe, as they're looking to develop their capital market system, and in particular securitization. I do expect a lot of opportunities to emerge over the coming years, as again Europe is acknowledging that it needs more credit formation in order to keep up with global GDP. And there's been a lot of efforts recently from regulators to focus there. So we expect to continue to see a lot of loan growth in terms of the need from the from the real economy, both in the U.S. But also, globally, and particularly Europe, and we do see Australia also being a active, issuer or funding source from securitization as well. So I think it is a global phenomenon. What we'll continue to see evolve is really, more and more assets coming into the space.
How can corporate borrowers benefit from asset-based finance, especially compared to more traditional credit options?
Yeah, it's a great question. I think what we're starting to see more and more is, some corporations looking at asset-based finance as an alternative funding source, as you mentioned. So there is a point in a corporation's life where the businesses are mature enough, and maybe depending on the type of business, will depend on whether or not ABF or securitization is right for them. But generally, what we're seeing is folks that have, some sort of contractual cash flow. If for instance, we're seeing a lot more fiber securitization. So folks that are literally laying down fiber, either commercial or residential, come to market. In recent past, we've seen franchises of different small businesses come to the market. We've seen even things like cell tower 5G expansion come into securitization in terms of how these deals get financed. So it's really more, once some of these borrowers or these corporations get larger, to the extent they have some sort of contractual cash flow where there is a lease attached to it, or there's some obligation to pay. Ultimately, from our perspective, we could underwrite that cash flow, and it wouldn't be dependent on that company being a going concern. So it wouldn't depend on the company's health. And that's where really securitization can come in and provide capital. But again, it's going to be very industry specific. It'll be very company specific. But there's definitely a lot more assets that we see coming into securitization.
And what risks should investors stay mindful of when engaging with asset-based finance in the current economic environment?
Yeah, the way that PGIM is underwriting these deals, we generally underwrite to a zero credit loss, and what that means is that we're going to take these cash flows and we're going to stress them, and we're going to build structural protections against different economic outcomes and market stresses. So generally, we're trying to build a cash flow and pay for those cash flows in a way where we think you're not going to bear credit loss. That said, there is always the risk that our scenarios aren't severe enough. In many of these cases, we are getting additional protection from either the end originator or the end borrower to give us extra protection. But generally, I would say the key thing here is really understanding the assets, making sure that the documents and the covenants are written in the appropriate way. I think what we're starting to see as other managers are looking to grow in the space. We fear that if they're taking they're open to financing riskier collateral. They're either providing less debt covenants, or giving more embedded options to the borrowers. So from our perspective, we remain fairly disciplined around lending to the right segments of the market, right? So you can mitigate risk by just staying lending against higher quality cash flows. You could mitigate risk by ensuring that your bond covenants remain very robust in terms of what you're willing to accept and not accept. And then economically, maybe this is not a credit risk point, but more from a cash flow point, making sure that we have appropriate call protection on some of these financings to ensure that if things do improve or continue to get better, the durability of the yield premium that we negotiate on day one and hope to capture, we can capture for the life of the investment.
Edwin, thank you. We're going to have to leave it there and get back to the forum, but I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Private Credit Investment Forum.
Thank you, Zelda. It was a pleasure.